So I did have a question that came in via email. I gave that, I gave a basic response to the customer related to a married put topic, but a little bit of a slant on the married put topic. And that was for Willy. And as you know, and as you've heard us discuss, we like to use the proper structure discussed in the blueprint to ensure our long stock holdings on the positions. We're going to buy a stock, buy the preferred put that's slightly in the money, 150 days out in time to control risk to single digits. Let's take a look at what comes up in the search. Sure, I'll see some ones that I recognize that might even still be in my portfolio. Actually, I don't. That's quite all right. That's perfectly fine. Let's see. That's a good position price-wise. We're going to go ahead and go with Planet Fitness here. This isn't a recommendation or suggestion. Actually, I'm looking for a risk that I would like to use. It doesn't matter in any case. It's all going to be the same. Let's stick with Planet Fitness as I mentioned it. If I was using this as a married put structure, I would buy shares of stock at $79.82. And following our default criteria, I'd also buy the June 80 strike put, slightly in the money. It's really at the money. I'd probably go with an 82.5 in this case. We'll take a look at that. But it's 161 days out in time. It's going to cost about $7.75. So my total invested would be $87.82, guaranteed to get 80 back. So the maximum risk is around 8.9%. Before we analyze this position, let me do one step further. I'm going to go to the search by symbol tool. Although the stock matches the basic criteria, the put is within the range of the risk we might use, but I feel it's a little bit high. If I decided I am bullish on this stock, and this is a trade I wanted to make, I'd go to the search by symbol tool. And I see what I wanted to see. Although the 80 has the risk under 10%, it's pretty close to right at the money. I want to go a little bit more in the money and have a risk of under 7.5%. So personally, if I was opening a married put on Planet Fitness and I decided I wanted that June series 160 days out, I think my likely target personally would be the 82.5 put with a risk of about 7.2%. The 85 is also a good possibility, only 6.5% in the money with a risk of 6%. But let's go ahead and go to the profit and loss chart for the June. Slightly more in the money, 82.5 put with a risk below 7.5%. All right, so let's just clean that up. There's our structure again, buying the stock at $79.82. At midpoint, we could maybe pay only $8.85. For 161 days, we have a completely controlled risk of 7%. Following the blueprint, we have 12 different income methods we can use in different markets to further lower that initial at risk, lower the break even, generate income, and potentially bulletproof the trade to where we have no risk. But Willy's comment that came in said that based on his jurisdiction where he is, he pays a very, very high tax for buying direct securities. I believe you said on ETFs, if I'm not mistaken, but that also might apply to standard stocks. However, the synthetic approach, meaning a synthetic stock position, Willy does not face as high or nearly as high as a tax burden. And he wanted to know, is it advisable and do you have information on using a synthetic married put as opposed to the straightforward married put? What would the synthetic stock, I should say, look like? Well, synthetic stock position consists of buying a call near to at the current strike price of the stock, and at the same time selling a put option, cash secured or just an open put option. If I did it by itself, it might have to be a cash secured put. I'd still have to put up the monetary requirement to cover the assignment of the put option in that case. However, if I'm doing it in the married put structure, I might just have the slight margin requirement because I have a long put in place, and selling a lower strike put might create that bear put debit spread. Let's take a look at this first. The total cost into this position, assuming the midpoint price, is $8,867 out of pocket. We're guaranteed to get $8,250 back because of the put option, so that would put us at a maximum risk of $617 as we saw or 7.0% against the cost basis. The synthetic approach, instead of buying 100 shares of stock, I'd go out to the same time frame personally, Willie. You had mentioned something about using a 250-day out versus another protection, but I want all the expiration dates to be the same if I did this approach. Meaning that what I'm going to do is I'm going to buy the at-the-money 80 strike call for June expiration, and at the same time, I'm going to sell the 80 strike put. So let's go to June. Let's click on our 80 call and our June 80 put. We're going to buy that call option, just one contract. We're going to leave our protective put in place, and we're going to sell the June 80 put as a synthetic. Let's make sure we extend this out. And what, of course, we're seeing is a very similar risk-reward profile to what we saw with the married put position. There's no monetary requirement in this case, but I think your broker might charge that. No, it would be a bear put debit spread. I'm sorry. In this structure, Willie, I'm sorry. When the put is below, the put I'm selling is below the put that I bought, that's a bear put debit. No monetary requirement comes in. Instead of an outlay of capital of $8,867, we're putting out $1,020. The bulk of that is for the $885 for the protective put we would have purchased anyway when purchasing shares of stock. The maximum risk goes up to $770. This is because in this particular case, we bought this call for $910 at midpoint, and we sold the put for $775. We have a debit here, okay, of an extra essentially $1.35, I believe, if I did that math correctly, which increases the risk that we would have had from 617, 620 up to the 770. Margin works both ways. This now represents 75.5% of the lower cost of $1,020 that I entered in the position. It's a bullish structure. It's going to profit as the stock moves up. You'd want to try to get this at a credit if possible. Maybe the 82.5 would give us a credit, but then I'm selling an in-the-money put, which I might want to avoid because I could be assigned at any time. Doesn't always happen, especially this far out in time, but that's another thing to consider with the structure, Willie. But this would be a synthetic structure. We're paying essentially 1/8 of the cost, a little bit less to get into the position. Higher monetary risk, but that's because we did not receive a credit. All things being said, if I was able to get fair time value for both, being right at the money, then the monetary risk would be just about the same. 617, 630, 635, but that's still half, 55, 56% of what I had invested into the position. But you see there in this case, as I mentioned, the monetary requirement starts to kick in, which added to that cost basis. I guess it didn't read it right the first time, but in any case, it's considered a parity trade in the sense that you have a similar risk-reward profile. Why it's not a direct parity trade to what we're doing is, let's say that I only had $10,000 right now to invest in a new married put position in my portfolio. If I did the full married put on Planet Fitness, remember, I'd put out 8,880 some for the stock in the put. My risk was only 617, about 0.6% of the total portfolio, or 7% of what we had invested into the position. Now, although this synthetic structure is helping Willy with his tax burden that he has for buying securities, shares of stock, or ETFs in those cases, what is the other allure of doing something different? Using leverage in a structure that we've been trading essentially for the past 14 years with the stock and the put and haven't deferred from it, even though we've had other radioactive users ask about it, other radioactive users and blueprint owners try it, and most of them usually come back after a few months and say they've just gone back to the standard married put. I don't have insight into why they decided to do that, but they went from the married put to the synthetic and then came back. A part of the reason might be due to that lie of leverage. So of my total portfolio, again, we know this position here would only represent about 0.62% Well, if I had $100,000, this monetary risk would be a small percentage of the total portfolio, and it's single-digit risk of the money I invested into the trade. The advantage, of course, of using leverage is it gives you more options. If I only had to put up 1,135 to enter the synthetic trade due to potentially the margin requirement that I'd have and the cost basis, the debit, of course, of the protective put that I'd be using anyway. You can say to yourself, well, I can enter now a total of maybe 6 or 7 trades with the same similar monetary risk that Mike has with his one married put position. The problem is that you might be risking $500, $600, or $700 or so, as we saw, on 6 to 7 different trades. So now instead of risking 617 or a 0.62% or small percentage of the portfolio, you're maybe risking as much as 4,900 if all of the 7 trades go against you in a sudden black swan event, which is a higher percentage of the portfolio at risk due to the lie of leverage. We have to remember it works both ways. I have no experience myself with doing this. I was upfront a little bit with Willy. I answered his email only with 2 questions, or 2 comments, I should say, that Ernie and I personally don't do this in our accounts. We don't regularly advocate for it. We don't regularly teach this as an alternative because we haven't done it ourselves in our portfolio. So we're not going to teach you the structure and what to look for and gotchas of implied volatility, things of that nature, because we just don't do it. We stay with the standard structure. That being said, we have had discussions with other radioactive traders, blueprint owners, Willy, who wanted to try this as well, made the leap, for lack of a better term, and attempted the synthetics. But the handful or maybe 10 investors I remember talking to about this, 60% of them told me a couple months later that they had moved back just in the standard married puts. And I never got a clear answer as to why. I don't know if it was an implied volatility issue in different markets. I don't know if they felt they weren't getting enough premium for the naked put they were selling in a low implied volatility market, which should have been countered by the lower cost of the call. I'm not really sure. Didn't get a lot of feedback. We still probably have 3 or 4 people that I talk to on a regular basis, maybe once every 4 months, that are regular power options users. And I look at their portfolio during a coaching session, and they have one of those synthetic structures set up either for a married put or even for a covered call or something along those lines. So, but we just don't have the experience to list all the gotchas that may come in or all the benefits even that might be over the married put. We've tried paper trading with it, didn't see much difference, had a little bit lower return with a synthetic than we did for whatever reason. Not commission costs, it's just maybe IV flux, maybe bid-ask spread, handling that with 3 options now to close or adjust as opposed to just using one with the put and then maybe another one later if we sell to open a call or do an income method. And that being said, though, if we go over to our YouTube channel real quick where we saw before, I'm going to try to do a search just for synthetics. Oh, wait, no, I'm sorry. I don't want to search there. I'm sorry. We want to search here on our own channel. Let me just look for synthetic. There's a synthetic stock position question from 3 years ago. It's not related to the married put. Synthetic collars, there's a discussion. Collar married put. Yeah, okay, there's one on protecting a synthetic long position. I thought there was one where we did a direct comparison, a little bit more in depth than what we just did here with some expectations of what you might see. I'll hunt that down for you a little bit. I thought it was going to come right up, but it doesn't look like the one I remember doing or think I was doing, Willy, is showing up in the results. So I'll hunt that down for you. I'll send you an email when I find it. There are stocks, as you can see. There's even one on creating a synthetic search on power options. I believe we were using a straddle or strangle position. A gentleman had asked, how can I use power options to find synthetic long stocks? We used one of the other strategies to create, it was a short collar search. That's what it was. It was a short collar search, but we took out the stock information. So they were just seeing opportunities that matched their criteria with a sold call. Strike that, reverse it. The long call and the sold put. And that got them to where they wanted to be. But there is a discussion in here somewhere on comparing a married put structure we use, radioactive trade, versus a synthetic married put or radioactive trade. And again, I'll hunt that down for you.